3 times in the last 12 years, governments legally took depositors' money, and now signs suggest it's coming to the United States. Imagine waking up one morning, thinking your money is safe in the bank, only to find it frozen, trapped, or gone. This isn't a story from some distant country or a forgotten headline. It's happened in real time, in places like Cyprus in 2013, Greece in 2015, and Lebanon in 2019. People lost nearly half of their life savings overnight. Others could withdraw only a handful of dollars a day, and some couldn't access their accounts at all for months. The panic, the confusion, the helplessness, it was absolute. And most Americans have no idea this law already exists here, quietly waiting in the background. The rules are set, the framework is in place, and history has shown us exactly what can happen when the system decides your savings are not yours anymore. Across every major banking crisis in recent history, a clear pattern emerges. It starts with banks taking risks, making investments that seem profitable in the moment, but fragile in the long run. When those risks fail, governments step in, not always to protect you, but to stabilize the system. And in that process, depositors, people who thought their money was untouchable, bear the brunt of the loss. This is where bail-ins and capital controls come into play. Unlike a bailout, where taxpayer money is used to save a bank, a bail-in takes money directly from depositors to recapitalize failing institutions. Capital controls, on the other hand, don't take your money, but make it useless, trapping it where it sits. And the frightening part? The same legal framework that allowed these measures in Cyprus, Greece, and Lebanon exists in the United States today. Your money is not as safe as you think, and the pattern is repeating itself, closer to home than most people realize. Cyprus, a small island in the Mediterranean with just over 1 million people, became a banking hub in the 2000s. Wealthy individuals, businesses, and even Russian oligarchs parked their money in Cypriot banks, drawn by low taxes and secrecy. By 2012, the banks had grown enormous, holding assets equal to 8 times the country's GDP. But those banks had made risky investments, including billions in Greek government bonds. When Greece restructured its debt, those bonds collapsed, and suddenly the banks were bankrupt. On a quiet Saturday in March 2013, everything changed. ATMs went dark, bank branches were locked, and a government announcement shattered lives. A one-time levy on all deposits, seizing nearly half the savings of those with accounts over a certain amount. People watched helplessly as money they had worked for, saved for years, was converted into bank capital without consent. Panic swept the streets, trust evaporated overnight, and the blueprint for bail-ins had been written, forever changing the way the world viewed its safety of its money.
A bail-in is different from anything most people have ever experienced. Unlike a bailout, where governments pour taxpayer money into failing banks, a bail-in takes the bank's own deposits and turns them into capital to keep the institution afloat. Imagine your life savings, the money you trusted would always be there, suddenly becoming part of the bank's balance sheet without warning or permission. It's legal, and it's been done before. Depositors lose control, not because of theft or fraud, but because the law allows it. And the ripple effects are global. What happens in one bank can affect economies, businesses, and families thousands of miles away. It's a harsh reminder that in the modern financial system, your money is only as safe as the bank's balance sheet, and history has already shown the devastating consequences when it isn't. By 2015, Greece had been struggling under years of debt and austerity. The economy was shrinking, unemployment was sky high, and the people were exhausted. When negotiations with the European Union broke down, banks faced collapse. Citizens knew what was coming. They had seen Cyprus. Panic spread, and money began fleeing the banks. Then, in late June, the government announced the unthinkable. Banks would close, and even when they reopened, withdrawals would be limited to just 60 euros per day. Elderly citizens waited for hours in the summer heat just to access the bare minimum for food and medicine. Families couldn't pay rent or import goods. The money was still in the accounts, visible on paper, but in practice it was trapped, powerless, and effectively confiscated. Trust in the banking system shattered, and Greeks learned a painful lesson. Even without a formal bail-in, governments could freeze and control your money, leaving you helpless. Lebanon was once called the Switzerland of the Middle East. Beirut was a financial hub. Banks were considered strong, and the Lebanese pound had been stable for decades. But beneath the surface, the system was fragile, a giant Ponzi scheme built on government debt and ever-increasing deposits. By 2019, the cracks were impossible to ignore. Citizens rushed to withdraw their money, but banks had lent most of it to a government that could no longer repay. Withdrawals were limited, first informally, then officially, down to as little as $200 a week. People became desperate. Some took extreme measures, holding bank employees hostage just to access their own savings. Families struggled to buy essentials, businesses collapsed, and trust evaporated. The money was technically in accounts, but practically it was unreachable. Lebanon showed the world a brutal truth. Even in a stable, middle-income nation with a sophisticated banking system, governments and banks can render your money useless without warning. Cyprus, Greece, Lebanon. 3 countries, 3 crises, 3 different methods, but the same devastating result. Ordinary people lost access to their money. In Cyprus, nearly half of certain deposits were legally seized overnight. In Greece, funds were trapped behind strict capital controls, leaving families with only a few euros per day. In Lebanon, accounts appeared normal, yet withdrawals were impossible, forcing citizens into desperation. The methods varied, but the pattern was identical. Banks grew too large, took risky bets, piling up Greek bonds, lending to insolvent governments, or running financial schemes dependent on constant new deposits. A crisis hit, and depositors bore the losses. Each time, governments acted within the law, and each time people thought it couldn't happen to them. Yet history shows it can, and it does. The lessons are clear. When trust breaks and systems fail, your money is vulnerable, no matter how safe it seems. When you step back and look at these crises, a pattern emerges, repeating itself with terrifying precision. Stage 1. The banking sector grows too big, far beyond what the government could ever hope to bail out. Cyprus 8 times its GDP, Greece 3 times, Lebanon 4 times. Stage 2. Banks take risky bets, chasing high returns, piling up Greek bonds, lending to insolvent governments, or running financial schemes dependent on constant new deposits. Stage 3. A crisis trigger exposes the fragility. Debt defaults, currency collapses, or geopolitical shocks make the losses real and undeniable. Stage 4. Bank runs begin. Once people sense danger, they rush to withdraw their money, but banks only keep a fraction in reserves. Stage 5. Government intervention occurs, but it comes with a cost: bail-ins, capital controls, or frozen accounts. Stage 6. The economic fallout lasts for years. Trust is destroyed, businesses stop investing, and entire economies stagnate. This 6-stage pattern isn't theory, it's history repeating itself, and it's happening closer than most people realize. The United States isn't immune. In fact, warning signs are everywhere. 6 giant banks alone hold over $12 trillion, nearly half of the country's GDP. Many regional banks are sitting on hundreds of billions in unrealized losses from bonds, and commercial real estate is collapsing after years of inflated valuations. Silicon Valley Bank, Signature Bank, and First Republic have already failed, sending shockwaves through the system. The math is simple. If panic spreads and withdrawals accelerate, these banks could fail too. And when that happens, your deposits could be the first line of defense, legally at risk through bail-ins. The stakes are real, the vulnerabilities extreme, and for ordinary Americans, the money they believe is safe might not be so untouchable after all.
Most Americans believe their deposits are safe because of the FDIC, but the reality is startling.
The FDIC insurance fund holds about $125 billion, while total insured deposits in the U.S. exceed $10 trillion. That means if more than a tiny fraction of banks fails simultaneously, the fund is wiped out. Anything above $250,000 in a single account is technically uninsured. And even for amounts below that, a systemic crisis could make coverage irrelevant. On top of that, modern technology has made bank runs faster and more dangerous than ever. In the past, people had to physically stand in line at branches. Today, someone can transfer $50,000 with a phone app in seconds. In one day, Silicon Valley Bank lost $42 billion through digital withdrawals alone. Panic spreads instantly via social media, creating a chain reaction that no bank can survive. In this environment, legal protections feel fragile, and your money is suddenly vulnerable in ways most people have never imagined. Picture this. It's late 2025 or 2026. A recession hits. Companies start defaulting, unemployment rises, and the economy teeters on the edge. A major regional bank announces massive losses and panic spreads. Depositors rush to withdraw their money, but the bank can't cover the withdrawals. It collapses. The FDIC steps in, but the fund isn't nearly enough to cover everyone. Other banks with similar vulnerabilities face runs as well. Within days, 3 more banks fail. Stock markets plummet 20%, credit freezes, and the president declares a financial emergency. Over the weekend, capital controls are announced, withdrawals capped, transfers restricted, and deposits above $250,000 converted to equity. Suddenly, $500,000 you thought was safe becomes shares in a failing bank worth just pennies on the dollar. The chaos is immediate, the fear tangible, and the realization hits hard. Your money was never truly yours. It was a loan to the bank. And in a crisis, the system comes first. The first lesson is simple but critical. Bank deposits are unsecured loans. When a bank fails, you were a creditor, not a depositor. Don't keep all your money in one place, especially more than the insured $250,000 limit. Spread it across multiple institutions to reduce risk. Keep some cash outside the banking system, in physical form, so you have immediate access if controls are imposed. Consider hard assets like gold, real estate, or other investments that exist beyond the reach of banks. Most importantly, have a plan. Know where you'll move money, what you'll buy, and how you'll react if withdrawals or transfers are restricted. Accept a hard truth. In a crisis, the government will protect the banks and the system, not individual depositors. Preparing in advance isn't paranoia, it's survival. Look back at Cyprus, Greece, and Lebanon. 3 countries, 3 crises, 3 lessons etched in history. Each followed the same 6-stage pattern: oversized banks, risky bets, a triggering crisis, bank runs, government intervention, and years of economic fallout. The pattern is clear, predictable, and terrifying. The United States has already completed the first 4 stages. The vulnerabilities are extreme. History isn't repeating by chance, it's following a blueprint. This isn't speculation or fear-mongering, it's math, it's law, and it's history showing us exactly what can happen. The warning signs are all around, and ignoring them could cost your savings, your security, and your peace of mind.